Well, the Westpac Melbourne Institute Index of Consumer Sentiment fell by 4.5% in June, down to 86.4. That was a bigger fall than I was expecting, and it's now comparable with the lows that we've seen in these major periods of economic dislocation. So we can go back to the COVID period in 2020, to the global financial crisis in 2008, to the deep recession in the early 90s, to the slowdown in the mid-80s and the recession in the early 80s. So these numbers are now comparable with those particular numbers. Now, what was driving this big move in, big fall in confidence? Well, 60% of respondents talked about inflation. Normally, 12% on average talk about inflation. So inflation has become the dominant factor behind the thinking of our respondents. Other areas in which they talked a lot were interest rates, the outlook for the domestic economy, and the outlook for the international economy. On interest rates, 64% of respondents are now saying they expect interest rates to go up by more than 1% by June next year. That's a substantial lift over the last few months. So a month ago it was 50%, and back in March it was only 30%. But despite this big fall in consumer sentiment, we're expecting that in the near term consumer spending will maintain pretty decent momentum. And that's because it's reflecting the reopening effect and of course the freeing up of more cash from the fall in the savings rate. So back in the March quarter, spending was $8.5 billion, but $6 billion of that was money freed up from a lower savings rate. The savings rate now at 11.6% still has a way to go. And of course, the household sector has accumulated around $250 billion in excess savings. So I think that augurs well for the June quarter and for the September quarter. And the other factor that's supporting my confidence in their spending in the near term is that confidence around the labour market remains incredibly strong. So we saw our index on the unemployment expectations today improved a little, and it's now 16% better than the long run average. So confidence in the labour market is an important factor that's going to maintain the near term spending momentum. Not such a good story for the housing market. There was a 3.1% fall in the question, is now a good time to buy a dwelling? That's now down at its lowest level since the global financial crisis. And there was an 8.4% fall in the outlook for house prices. That index is now down to 111, still above 100. So nationally, there's still an excess of optimists thinking prices will rise than thinks prices will fall. But the story is quite different across the states. So in New South Wales and Victoria, the falls were 10% or greater, and those indexes are now hovering around that 100 level. And I'm very confident that very soon the pessimists will overtake the optimists in terms of the outlook for house prices in New South Wales and Victoria. On the other hand, there was a 3% lift in confidence in Queensland. That index is now around 125. So the strength of the Queensland housing market is very much coming through in this survey. We also ask respondents every 3 months about where they think the wisest place for their savings should be. And we saw 64% say in capital protected investments or pay down debt. That's the highest proportion we've seen since the global financial crisis, when it was a bit over 65%. So we're seeing a very risk-averse group of respondents now. Well, on July the 5th, the Reserve Bank is going to be meeting to consider interest rates again, and we expect that they'll decide to raise rates by another 0.5%. In the videos that we've been giving you over the last month or so, we were arguing very strongly that the move in June should be a big move rather than the 25 basis points that was favoured by most analysts and by then the market as well. Because the right policy is to move quickly at the early stages of the cycle. That's when interest rates are well below what I would call neutral. And so the danger of going too far too quickly is lower when rates are very low. And then of course what you need to do is slow down on the pace of tightening as you move further into the cycle. We're expecting by the end of the year the cash rate will be up at 2.1%, and early in 2023 we'll see the end of the cycle at 2.35%. Now, the most important factor behind that expectation is that there'll be a very marked slowdown in inflation next year. By the end of this year, our forecast is that headline inflation will be at 6.6%, but by the end of next year, we think it'll be a bit above 3%. And 4 percentage points of that slowdown in inflation is going to come from 4 components. The first one, we think that fuel prices will be falling next year, that the cost of building a house, particularly in the cost of building materials, will still be rising, but at a much slower pace than we saw this year. That food prices will still be rising, but once again at a slower pace as the disruptions from the floods, and we expect from the European war next year start to ease. And that electricity prices, while still rising next year, will be rising at a much slower pace. And these are all what we call adjustments in the supply side shocks. So those factors, I think, will move in order to bring down the huge inflation problem that we're facing at the moment. Of course, the rate hikes by the Reserve Bank will be important at the moment, and under the weight of those rate hikes, we're expecting that growth next year will slow from 4% this year down to 2% next year, and consumer spending will be running well below trend. We're also expecting to see a contraction in housing investment in the second half of next year, and business investment to slow. So next year will be a very slow year, but that's effectively what we need in order to achieve that slowdown in inflation. And if we do achieve that, then we won't see the Reserve Bank having to go to the sort of extent that the market is currently expecting, where they're now expecting that the cash rate will go well above 4% next year. Thank you very much.